that it was a stellar show both on margins and on growth. So just a couple of these platform companies that you'd want to look at. But this morning, the first tick on the index is in the green, up about 30 odd points. The Sensex is up about 76 points as well. The big mover, really, the big gainer is Hero MotoCorp, up 1.5% on the back of a solid booking coming in for their new Harley Hero bike. HUL, Tata Motors, SBI, Titan are a couple of other stocks that are looking pretty good at the moment. And NTPC as well, holding up in the green. Divi's Labs, I was telling you earlier that, this year, Divi's Labs is now up 15%. This week, it's up almost 5%. This month, it's up almost 7%. So good going there. By the way, Gland Pharma is really the stock to be in the broader markets. Very good set of numbers. So that stock is up almost about 9% now. Clearly the stock of the moment. On the downside, though, you have Power Grid, Britannia, Eicher Motors, Adani, Infosys that are just a tad bit in the red. Adani Ports comes out with numbers as well, so keep an eye out on that. ONGC, IndusInd Bank are a couple of other names. So largely you'd have to say it's a quiet start, but definitely all the action is in the broader markets. PB Fintech, Gland Pharma, Max Healthcare, all reacting to a good set of numbers.
Well, that's right. Let's focus on a couple of other names. ITD Cementation, those numbers look quite good. So that stock, in fact, was up close to around 5%. Volumes as well quite high in pre-open. So let's get ITD Cementation up for you on the screen. Zentek, second day running, that stock is up close to around 8% in pre-open. Yesterday it was up close to around 10% on the back of good numbers. So that one should come up for you. Peninsula Land as well as On Mobile Global. Normally we don't talk about both these two stocks. Both of them had come out with numbers yesterday. So both of them, in fact, up for you on the screen. GIC Housing in pre-open was under some pressure. It's had a bit of a run from the recent lows. Monte Carlo as well was a little bit tepid in terms of its start. So, you should get Monte Carlo as well. Electra Green Tech, the stock has been all over the place, went almost to around 1,500, then it came down to around 1,100 approximately. Monte Carlo is getting a hard knock, actually it's down close to around 10%. Electra Green Tech as well is down close to around 5%. And Rainbow Hospitals as well, the children's arm, well, that had a big re-rating event from 500. It went all the way close to around 1,000 rupees odd. But I think this morning, the start at least was a bit in the red, down close to around 2% odd.
Okay, well, Gland Pharma is the big mover today, isn't it? 9% higher, and it's coming up with very strong volumes as well. So 1462 on Gland Pharma, and there you go. That's a mover. These smaller railway, Railtel, for example, 4% higher. Hero MotoCorp, right? We were talking about those bookings for the premium bike. Stocks starting about 3% higher, 3,032 on Hero. We've got BEML, which is starting about 6% in the green, strong gains. We mentioned ITD, all these cable companies, Universal Cable, Birla Cable, Phoenix Cables, these were all up between 8 and 10% yesterday. Birla's coming up with volumes, 3% on this one, Birla Cable. Indigo Paints, results reaction, 3.5% higher. Texmaco Rail is up 3.5%. Inox Wind, 4% in the green, 219 on Inox Wind. There is KEI, which is up 3%. Right out of the gates, huge volumes. Rategain is up 2%, 2.5%. There is Action Construction Equipment, which is up about 3.5% as well. So this is, a good-looking buzzing screen that we have at this point in time. Yatharth, which is the company which listed yesterday, had a strong debut, starting 2.5%, 3% lower this morning. And Max Health is down 2%, so 570 on Max Health. So that's the other one. Tata Chemicals is down about 1.4. Sonal was just highlighting commentary from the call, and PB Fintech is down about 2% as well. So that's basically what you have. GIC Housing Finance, that's down 9%. 185, 186 on decent volumes for this point in the day. So that's another one that I just want to kind of mention. 13 points on the Nifty, so it's flat, 19,612, almost at yesterday's day's high, but it's a small but positive start. Harsha Upadhyay is Chief Investment Officer, Equity at Kotak Mutual Fund. Harsha, great to have you with us here. Thanks very much for your time. Good morning. What's the broad kind of focus or sort of thinking about markets at the Kotak investment team, Harsha? Are you guys still a little cautious about the run that we've had? And of course, we are well into the earnings season, so perhaps you have a bird's eye view of how earnings have panned out. That has also been one concern for you for the last 2 quarters at least. Go on.
Good morning, Prashant. Clearly, the earnings season has panned out more or less in line with expectations, I would say. Nearly 80% of the companies from the Nifty basket have announced results until now. And I would say a majority of those have either met expectations or have exceeded expectations, not by a large margin, but by a small margin. So to that extent, the bias towards companies which have seen either stable earnings growth or a slight bit of upgrades is higher. So we believe that the confidence in terms of reaching those mid-teen kind of earnings growth for the next 2 years on the Nifty basket is definitely quite higher, given how this earnings season has panned out. Having said that, we should also remember that we have seen very, very strong inflows from foreign shows for the last 4 months, which has driven the markets across the board, not just large caps, but more so in case of mid and small caps. And to that extent, the valuations have definitely moved up higher than our comfort levels, at least in the immediate term. So to that extent, we continue to remain a little cautious on the markets.
Okay, continue to remain a little cautious on the market. By the way, the big Nifty gainer right now, the biggest Nifty gainer is Hero MotoCorp after that fabulous response to the Harley-Davidson X440. Remember, the bookings will be, the deliveries will start from October of this year, but they've already received almost 26,000 bookings for the new Harley-Davidson. But just want to point out that if you compare the performance of Hero to Bajaj Auto, right, Hero has seen a big underperformance this year. The stock is up 10%, while Bajaj Auto is up 30%. So it's definitely playing catch-up to some of its peers in this space. Harsha, thanks for joining in. I wanted your thoughts here because the premium end of the market is definitely picking up, right? Not just in two-wheelers, but across real estate, other pockets as well. How are you feeling about that, and what's the best way to play it?
Definitely, when you look at consumption basket, the premium end has remained quite resilient all through the COVID period as well, I would say. And even post-COVID disruption, we have seen that basket doing relatively better than the rest of the consumption basket. And our thesis on two-wheelers is definitely we have seen some of the large disruptions in the market in the recent parts with electric vehicles coming in, with margins going down, with no new product launches affecting the consumer demand, etc. And at the same time, even the valuations had taken a knock in this basket, and just in line with what had happened the overall automobile sector, as well as, in particular with two-wheelers. Now that we have seen new product launches, now a little bit of stability on the volumes, and as we know, most of the manufacturing segments, including two-wheelers, will gain from moderating inflation on the raw material side. We should see better earnings growth from this basket, and that's what the market is reacting.
Hi, Harsha. Morning. Good to hear your thoughts as always. Harsha, what do you make of these new age themes? They were down and out, but some of them have come back in style. They're making the right noises right now. The management commentary as well is looking up, and they're on their path to profitability. Do you like some of these stocks in there, and what would be your pick?
Nigel, I can distinctly talk about two phases in the past. One was just around the time when most of these companies got listed. There was complete euphoria, not just in our markets, but across the board, across geographies, and that led to euphoric valuations. And later on, we had valuations coming off across the board, and more so in terms of the high-tech or the internet companies in other geographies as well as our markets. We did see a lot of other overhangs also playing out in terms of existing shareholders selling out, some management changes in many of these companies, etc. Now we have seen a little bit of stability, at least in some of those companies. Obviously, it's not a homogeneous basket. So to that extent, we'll have to evaluate them on a bottom-up perspective. But those companies which are delivering on the promises made earlier, those which are moving towards path to profitability with a visible roadmap, are the ones which will probably tend to outperform the rest of the basket, in our opinion. So I think the one-way move upside and the one-way move downside were things of the past. Now on, it will be based on how these individual companies will perform going forward, and that's what will determine their stock performance in our.
Harsha, I wanted to ask you about small caps. I reckon there also you kind of take a sort of stock-specific kind of view. But again, the up move in the small caps particularly has been dizzying, right? As someone was joking, it's like 0.5% daily compounding. It's literally been that for a while. What do you make of it, and what is the approach broadly now at Kotak? If you can kind of provide us with some granular details about your thinking.
Prashant, you're right. I think if you look at the small cap basket, that has done much better than the large cap basket. And most of the foreign liquidity that we have seen in the recent times has moved into mid and small cap basket. Not so much into small caps, but definitely into mid caps. And we are continuing to see that liquidity coming in. And at the same time, we have also seen a definite shift in terms of the SIP numbers within our domestic market, wherein a large proportion of investors have tilted towards mid and small cap SIPs. Rather than large cap oriented funds in terms of SIP investments. So overall, given that the fund flow has been very, very strong at this segment of the market, and the fact that these are not very liquid, we have seen a kind of a larger move as compared to large caps in this basket. And clearly, as I mentioned, the earnings delivery and the sustenance of flows will be very critical for this basket, more than what you would say for example, large caps. So to that extent, they continue to remain more expensive than large caps. But yes, if you believe that there is an earnings cycle which has turned around, and over the next 3 to 5 years, India is going to do much better than the rest of the economies with more of the segments participating in that growth, then definitely even small caps would be an interesting area. But at the same time, one should remember that given the kind of very sharp up move that we have seen in the last 4 months or so, it cannot be a one-way market from here on. One has to prepare for some volatility at some point of time in India.
What are your thoughts, Harsha, on what's happening with the banking space? The banks are just not performing, and there's of course one theory that perhaps the best of the banking performance in terms of earnings is now behind us, and margins are going to moderate from here. Would you sort of agree with that view? And if yes, would you churn out of banks and into any other sectors?
Sonia, I think clearly the ownership has been the single biggest factor driving the performance of banking stocks at this point of time. While, as you rightly mentioned, the results have been very, very strong, we have not seen commensurate stock performance, since most of the institutional investors already have kind of a reasonable exposure to this segment. While margins are definitely going to look a little softer going forward, we still believe that the earnings growth for this basket is going to be better than the average market earnings growth that we would see. So to that extent, we cannot say that this segment is going to underperform over the next few quarters. But at the same time, I think the kind of outperformance that we have seen from this basket maybe is going to moderate. So to that extent, there cannot be a uniform kind of a rally in this segment, which is true for the entire market in our view. Most of the market segments, most of the sectors have gone to elevated levels of valuation. So to that extent, we cannot expect a uniform kind of an up move from here on. It has to be more stock specific.
Harsha, what about the old economy stocks, cement, infrastructure? How do you play them? Getting into election, you see some bit of ramp up, some increased spending as well. What do you like from these themes?
We continue to remain very positive on this basket. Even though we had COVID disruption over the last 5 to 6 years, we have seen overall investments doubling. That is private capex and public capex. When I say public capex, center and state put together, this entire aggregate number has almost doubled in the last 6 years, despite the issues that we have seen in the economy. And there is no reason to believe that this kind of a growth rate cannot be met over the next 5, 6 years. In fact, it's going to be much higher. And also, if you look at the immediate near term, there's an election coming up. So to that extent, most of these investments which are earmarked for growth will also go into many of those projects in the next 3 to 4 quarters. So clearly, the demand is likely to remain very, very strong for this basket. We do have a very positive opinion on that. Some of these sub-segments had seen a bit of an earnings growth issue given what had happened during COVID, and also because of the cost inflation that had come through over the last 4 or 5 quarters. Now that the inflation is moderating, we should definitely see a larger profitability move as compared to overall top line growth in some of these segments. And that's what we are excited about.
All right. We'll let you go on that note, Harsha. Thanks a lot for joining in. Appreciate your thoughts here on CNBC TV18. That's Kotak Mutual Fund. By the way, a lot of stocks actually in focus right now. Gland Pharma is really your stock of the moment, up 13% post numbers. But let's connect with the management of Max Healthcare. Very strong numbers. Across the board, actually, hospital companies have been doing very well. Good revenue growth, average revenue per occupied bed has also surged, but the occupancies are at the lower end this time. Abhay Soi, the Chairman and Managing Director at Max Healthcare, joins us now to talk about that. Abhay, pleasure speaking to you. Thanks a lot for joining in. Can you start by telling us what the guidance is on the revenue and the average revenue per occupied bed? Wanted to understand what are you expecting going forward, because on a quarter-on-quarter basis, occupancies were a bit flat. But what do you see in the subsequent quarters, and what is the growth that you can eke out?
So quarter-on-quarter occupancies were flat, like you rightly pointed out, but do keep in mind that the fourth quarter is the best quarter in the year for hospital companies, and the first quarter tends to be the weakest quarter of the year. In fact, usually the gap ups are a lot more than this. I'm quite happy to sort of look at the occupancies in the current quarter compared to quarter four. I mean, you'd see there's an increase Y-on-Y as far as occupancy is concerned. And on, like you rightly pointed out, on the quarter-on-quarter, it's sort of flat or marginally 1.9% lower. But like I said, that's true to the seasonality of hospital plays. We're expecting it to pick up like it does every year. I think if you just take the exception of the COVID years, of course, but otherwise you'll see a secular trend up as far as occupancies are concerned.
Abhay, hi, good morning. What about margins? I mean, can we extend that same point about the seasonality of it there as well? Because margins were down, I think, about 260 basis points Q1Q, and they were down some 15 basis points year on year. How would things look from here?
Look, I think, there's something I don't focus on is margins. What I look at is absolute value, which is EBITDA per bed or EBITDA. Because the moment you start doing high-end business, be it on the clinical side or the payer side, you have lower margins, but you have higher amount of absolute value EBITDA which is coming in. So, case in point is that you'll see, our international business has grown by more than 31% year on year. And international business is high ARPOB, is high overall EBITDA per bed and high absolute EBITDA. But, on an overall basis, there's lower margin. So if you look at, some of the other things that we've gained from, which is oncology, we've looked at, you look at cardiac sciences, robotics, which is more than doubled over the last 1 year. All of these are low percentage margin businesses, but high absolute terms. So, I keep saying this, you'd rather do a $10,000 surgery at a 20% margin than a $2,000 surgery with a 50% margin. And look, you see that as far as ARPOBs are concerned, and you see the result of what I'm saying as far as EBITDA is concerned, because you had a massive increase over last year, year on year, as far as EBITDA is concerned. And yet, compared to quarter four, which is the best quarter in the year, like I mentioned earlier, and quarter one being the weakest, that aside, you still have a flat EBITDA Q on Q, which in my memory, I mean, pre-COVID, has never happened before. So quarter one is always lower than quarter four, because on 1st of April, you have salary increases, etc., which typically need to get absorbed through the growth, which happens through the year. But this is the first time that we're seeing that it's flat. So I'm very, very sort of encouraged about future quarters.
All right. Hi, Abhay. Good morning. So what should the EBITDA per bed look like then? On a broad range, if you could give us. And also the international business that you mentioned, it's growing very, very well, more than 30% on a year-on-year basis, 9% of the revenues. Has the Afghanistan, which was a key market, has that come back?
Well, I mean, fortunately, unfortunately, this is in spite of Afghanistan not having come back at all. So our business from Afghanistan is zero as we speak. And we're expecting it because we've seen some flights which have started recently, very, very recently from Afghanistan. So we are hopeful that in the coming quarters, this business should come back. This used to be about 10-12% of our total international business. So we are encouraged by, like I said, these maiden flights which have just started recently, and we are hoping this business comes back soon. I will not be able to give you a guidance as far as EBITDA per bed or revenue, because I sort of normally stay away from guidances.
Sure. Yes, we know that. But I wanted to talk a little bit about the diagnostics business because, there's so much happening there. There's so much competition as well. But you folks have managed to eke out what? Almost a 39% growth, double-digit growth across the board. In your diagnostics business, in Max at Home business has grown 24%. Are you profit-making as well? And what kind of growth can you see in the diagnostics business here on, considering that there's so much competition now?
We've seen a 35% growth for the last 5, 6, 7 years in the diagnostics. Of course, it's on a smaller base. Like you rightly pointed out, you had a very good year-on-year growth, but even on a quarter-on-quarter basis, Dunia, we've grown by 10%. This is over Q4. So yes, this business is doing well. We're hitting the ground hard. We believe there's a space for hospitals because of the higher value proposition that we're able to provide through our labs, which are state of the art, and where it's manned by professors, it's manned by DNB students, and so on. And what we are being able to do is convey that excellence, in the perception as well of the hospital. So it's sort of working for us. And we are quite, I believe, Max Lab and Max at Home, both, and by the way, both are profit making. Max Lab a little less so, and Max at Home does a mid-teen sort of a profitability. These are large businesses of the future, and we are very sort of hopeful about this.
Taken some price increases as well, right, Abhay, in June, especially on the radiology side?
Sorry, I missed that.
Abhay, you've taken some price increases as well on radiological imaging. Large number of tests have undergone price revisions?
No, so I think there have been two things. Every year on the 1st of April, we have price increases, which are usually about 2.5% of our top line impact. But what has happened in June is CGHS, which is the central government health scheme, that is, or the institutional business that we do. The government, after 40 years, actually has revised rates as far as diagnostics and room rents are concerned. Combined, this doesn't move our ARPOB by even 0.5 or 0.6%. So it's not a big market. Yeah, so the price revision in the CGH has happened because we haven't revised the price, the government has revised the price.
Okay.
And like I said, but it's a very, very marginal increase on ARPOB and our revenue. It's less than 0.5%.
All right, Abhay, what do you plan on doing with your holdings? You had KKR who exited a few months ago. Now you're the largest shareholder with 23% odd. Do you want to cash out at some point of time, or do you intend to continue holding on?
No, I don't intend to cash out. I've never sold my shares and I've never levered my shares. Even at the cost of potentially increasing my shareholding. So that's not the sort of business I'm in. I'm not a private equity, it's an individual holding, and I'm seeing great potential. We're doing huge amounts of capex going forward. I'm seeing a flywheel effect. All the development which is being done by the government is, sort of winds beneath our wings, and the opportunity to sort of just participate in this development through investment in capex, and the great opportunity that we have ahead. Is going to keep me occupied. And I'm short of 50 right now. It's going to be my 50th birthday, so
Abhay, the short point is we get that you're committed to the business because there'll be various analysts on the street who will talk about the stock, but you'll be the best analyst on your own business, and that's what we wanted to hear, right? You believe that there's good potential, so that clears the point. Final question before we let you go. Institutional business is around 29-30% of your total business. Any outstanding receivables if you quantify that amount, or has the money been coming in?
No, so money's been coming in, and I think we've also recently opened about 130 odd beds at our Shalimar Bagh facility, and so we had to sort of be a little more accommodative as far as institutional business is concerned, because new capacity, the first sort of this thing is to occupy it. But if I look at the institutional business X, the new capacity, we're down to about 27%, so it's come down. And the government has revised rates, and they're scheduled to revise hopefully some more rates in the near term. So we have not been taking any significant actions as far as reduction of the business is concerned.
Okay, I like it when you said, you're short of 50 and you have still a long time to go. 50 is the new 40, isn't it? So we hope best of luck. I'm sure your, shareholders, stakeholders would love the fact that you continue to stay on and not looking to exit anytime soon. Abhay Soi, thanks a lot for joining us on CNBC-TV18. All right, let's move on. Godrej Consumer reported a good set of earnings in Q1. Margins have expanded, the home care segment has grown 14% and organic volume growth has been good. Sudhir Sitapati, the Managing Director and Chief Executive Officer, is with us. Mr. Setupati, thanks a lot for joining in. Can you tell us from these Q1 results, what can you infer for the entire year? Will this kind of performance sustain?
I think we had a good first quarter. A lot of it has been due to some of the initiatives that we've done in category development to grow categories faster. That part of it will continue. But I think, household insecticide had a good quarter driven by some amount of seasonality that may or may not persist in the next few quarters. So I would say this has been an exceptionally good quarter, but we expect to have reasonably good results, perhaps not as good as this one in the next few quarters.
Got that. Then what kind of growth do you foresee for the year then?
If you look at our organic volume growth in India, it was about double digit. That is probably not the volume growth trajectory of the India business yet. We used to be in kind of low, mid single digits. I think it's higher than that, but double digit, I think we've gone past that pip because of certain external circumstances. Our Indonesia and Africa business, I think, will persist and continue the way they've grown in Q1.
Right, Mr. Sitapati, by when can Indonesia get to a 500 crore per quarter run rate, and how much more will Nigeria's currency impact be?
I think Indonesia, the macros in Indonesia are quite good. It's one of those countries that is doing quite well in the last few quarters. And our business, after some turbulence, has started doing well. So I don't exactly know when we will hit 500 crores a quarter, but this is a business that I anticipate over the next few years to do quite well for us. Africa continues to be pretty high turmoil. Nigeria in particular had a very big devaluation last quarter. Some of that devaluation, the impact on our P&L will be optical, some will be real. That devaluation is, by the way, generally good for our business and generally good, I think, for the economy when the currency goes to free float. But Africa continues to be politically volatile, especially on the currency front.
Okay, Africa continues to be politically volatile. Where do you see gross margins, ad spends and EBITDA margins for the year? Any kind of trend that you can give us?
I think, we are constantly looking at our primary focus is volume growth. And we really try and push volume growth to the maximum possible. The EBITDA margins, what they are in FY24, the EBITDA margins are pretty similar to our historic highs, except that the shape of our P&L has changed quite a lot. Our gross margins are lower than our historic numbers. Our advertising is higher, but our costs are significantly lower than our historic numbers, roundabout coming to our historic EBITDAs. So, again, I think the important thing is volume growth. The important thing is to invest in advertising. And the EBITDA numbers, that come will be a consequence. Q1 is quite reflective of the EBITDA numbers that, at the current situation look quite healthy at about 20%.
All right, Sudhir, when will the value and volume gap for soaps business narrow down?
No, I think in soaps, the Q2, the gap between volume and value will be pretty high because Q2 last year and beginning of Q3 last year was when oil prices peaked and soap prices peaked. And therefore, you've got a really tough base in terms of value. So there will be a pretty big gap in Q2 and the beginning of Q3 in terms of value and volume on soaps. The premiumization impact in soaps is not large enough as a category. It is not one of those categories that is rapidly premiumizing. And that is not big enough to counter-effect the impact of the price drops.
So what is the target for Raymond in terms of revenue scale-up and synergies from here?
Yeah, I think, Raymond's is very much work in progress, and we're quite happy with the progress that we've done. We first got to get the business in the right shape. We've got to reduce our inventory, we've got to reduce accounts receivable. All of these are very different from GCPL norms. So, in Q1, we did whatever had to be done. In Q2 also, we will do it. We hope that in H2, we will start seeing significant synergies both on the revenue line and on the cost line.
So what would the volume and margin impact of the 900 crore capex announcement be?
I think the capex investment of 900 crores, which is quite sizable over the next 3 years, it takes into account 3 factors. One, that we are bullish on our volume growths. We are seeing that our investments are paying back on volume growths, and we anticipate that our volume growths will be higher than our historic numbers. So we've got to put the capex for it. Second, we feel that the logistics costs of our business will reduce with this capex, and logistics costs now play a more and more important role. And third, we hope that with automation, our production costs, or our conversion costs as they're called, come down as a consequence of this capex. So the capex does about half of it is for volume growth and half of it is for efficiency.
Okay, thanks a lot for joining in and appreciate your time here. Let's slip into a quick break. On the other side, Hemant Jalan of Indigo Paints will be with us to discuss their Q1 FY24 earnings. Stay tuned.
Okay, welcome back. I mean, the Nifty is like a traffic signal, blinking red and green, not very much at all. Absolutely flat. 19,590 is where we're at, where we were yesterday by 3:30. Well, strong numbers from Indigo Paints. Revenues have come in strong, margins have expanded, and we have Hemant Jalan, Chairman and Managing Director at the company, now joining in to take some questions. Mr. Jalan, good morning. Great to have you with us here on the program.
Morning.
Here at CNBC-TV18. Prashant this side. So, the first question is, what are you doing differently for you to be able to grow at 3 times what the industry is growing? Has there been a new product line, some campaign? Because you're far outpacing what the industry is growing at.
Well, Prashant, go back 2 years in time to the time of our IPO and look at the 10 years that preceded our IPO, and you'll find that we always outpace the industry growth by a factor of 2 or 3. It is only in the year after our IPO that our growth kind of tapered off and came back to the industry bandwidth of growth. Last year, a year ago, we announced a renewed strategy to focus on the larger cities, as opposed to our erstwhile focus on the smaller towns. And, sometimes when you announce a new strategy, it does take a few quarters for the results to start manifesting themselves. And happy to see that we are getting our mojo back and returning to where we were of, not just 2x the industry growth, but maybe more than 3x the industry growth. Of course, we need to sustain it for a few quarters for the belief to come back in that we are going to consistently be doing that. But that's what we hope to do in the quarters ahead.
What about the current market share? What is it at right now? And how much do you plan to grow it by over the next, say, 1 to 2 years?
I don't think we look at the share prices.
The market share of the company, sorry. I meant
Pardon?
market share of the company.
Oh, market share. Oh, okay. I
Yeah.
thought you were referring to the share price.
No.
The market share is still very small. It is maybe around 2.5%. And therefore, the headroom to growth is huge. Obviously, we'd like to catch up with the big boys in the industry. In this industry, nothing is going to happen overnight. It is going to take time. And if we continue to outpace the industry growth, it would be a few years before we start emerging as a possible number 3 player in the paint industry. So we take it one step at a time and keep increasing our market share steadily. Nothing is going to happen with a big bang. And that's where we intend to be headed.
So from this 2.5%, as you said, right, there's a big scope to grow. Are you looking at what, 5% by the end of FY24, double-digit market share perhaps in the next 2 years? You must have outlined some sort of target for yourself. And do you plan to gain market share at the cost of perhaps margins? I mean, could that be a strategy for the next few years as you penetrate the market further?
Growing at the cost of margins has never been part of our strategy. And if you look at the results for the last 8-10 quarters or as far as back as you can go, our gross margins have always been the highest in the paint industry, even higher than the industry leader by a very wide margin. Our EBITDA margins are close to being the second best in the industry, and so also our PAT margins. So growth at the expense of profitability is never in our DNA, and I don't think we intend to pursue that course. As far as what market share we achieve at the end of what time frame, that's a little difficult to quantify. But yes, in a period of 2 to 2.5 years, if we can double our sales figure, which would mean growing at a compounded rate of slightly over 30%, that is what we aspire to do. How far we are able to achieve that or whether we exceed that, only time will tell. But the headroom to grow is so large that it would be silly to target anything less ambitious than that.
Okay, all right. Hi, good morning, Mr. Jalan. Just to understand that, in the next few years, the target is you double your revenues. Will you require to incur capex, or do you have already the capacities?
No, we had announced a large capex 2 years ago in Tamil Nadu. That project has come to an end. It is under trial production phase for the last 1.5-2 months. We are just awaiting a few final clearances, which we hope will come through in another week or 10 days, after which we will declare commercial production. And that capacity should be good enough to see us for the next 2 years. But 2 years down the road, with the kind of growth that we are expecting, I think that we will again start facing a capacity bottleneck. So we have announced that we are starting work on a new 90,000 KL per annum water-based paint plant at Jodhpur, for which work has just commenced. And we hope that that would go on stream in about 21 to 24 months from now. And that should take care of our capacity for the next few years.
Mr. Jalan, for this year, that's in the near term, FY24, what kind of a revenue growth are you penciling in? And also margins, what should be the rough range from around the 17% odd for the near term?
I don't like to give a specific number guidance, but I think we'd be happy if we ended the year at a 30% plus top line growth. I think as far as EBITDA margins are concerned, we'd be happy in a 19 to 21% bandwidth. That is what we strive to attain. And if that happens, then the PAT margins would obviously be somewhere in the range of about 13%. But I would shy away from giving very specific number guidances because they're somewhat dependent on the fluctuations in the raw material prices. At the moment, they are a little benign, and they have been soft for the last few quarters, but that is something that is completely unpredictable. And should the raw material prices turn around and start going up, that could have a slight short-term effect on profitability.
You know, we have a bunch of other questions, especially competition, right? But we'll leave it for another time. We're out of time. So thank you very much for beautifully explaining the strategy and, you know, what you aim to do at Indigo Paints. Congratulations on a very healthy set of numbers. We've got, what, 2% on the stock, 1626. Well, the market is not doing very much, so it's down 8 points or so. And things are on the flat side. Market breadth, broader markets, just fine. 1,250 stocks are higher, 770 stocks are lower. Mitesh is with us with a quick check on things on markets. Mitesh, welcome back. On the index, any trade and any fresh stock-specific trades?
Good morning again, Prashant. I think on the index, you know, we have some put options. We are holding on to them, not adding on to the futures side, because I would want to short closer to about 19,650, and we haven't reached there as yet. So we'll either wait for a decisive breakdown on the hourly and the 2 hourly charts, or wait for this pullback to play out and then go short. My sense is that we might not be able to get past 19,700 on the Nifty. So 19,650, 660 is the preferred shorting area. Having said that, on the stock side, I have one buy and one sell. Nestle is something, I think, you know, which is looking negative. It's breaking down. So recommend a sell here with the stop at 22,400 to 50 and a target of 21,750. And Biocon is something which is giving a breakout on the upside. So that's a buy with the stop at 265 for targets of 285.
Okay. Well, I just wanted to talk a little bit about Maruti and the fact that, you know, Maruti will be acquiring SMG from Suzuki Motors. So Suzuki Motors Gujarat will be acquired by Maruti from Suzuki Motors, as we know that the news came a couple of days ago. Now, they have given us a lot of details on how that acquisition will be done. The board has approved a preferential issue of Maruti equity shares to SMC. And they say that the option of acquiring SMG shares by an issue of Maruti equity shares to SMC would be beneficial to minority shareholders and would be beneficial to Maruti as well. And hence, that's why you're seeing the stock up almost about 0.3%. They have said that there are three, options that they have evaluated. And in all three options, they speak about how the profits would be higher, the EPS would be higher, and the dividend payable would be higher. 3 swap options is what they have put on board. So they have, given a very detailed analysis of what happens with the swap options and what the eventual impact would be. It's positive for shareholders, minority shareholders, as well as positive for Maruti, and hence, the stock is up in the green.
We'll have to wait by for the amount of dilution, right, Sonia? I mean, as of the last reported number, I think SMC's net worth was around 12,500, 12,700 crores approximately. If they do it at current market price, then it will be a dilution of around 4.4% or thereabouts. So we'll be waiting for further details. This could have been done either by cash or by issuing shares. And as of now, they're tilting towards the preference share allotment route. Sonia will get us more details on that front. But for the time being, let's turn our attention away from the equity markets. Manisha is standing by to tell us what's going on in the commodity space. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, I'm looking at the metal prices, which have seen a decline, especially after the China data that came in. The trade numbers came in on the much weaker side for the month of July. We've seen a double-digit decline for import and export numbers and much lower than what the street was anticipating. So the exports for the month of July on an year-on-year basis in China are down 14.5%. Imports also have declined 12.5%, and that is weighing onto the metals as a sector there. The steel prices, in the meanwhile, are trading at an 8-week lows. Iron ore has slipped to a 2-month lows, and copper is off its 3-month highs that we saw it trading in the couple of weeks ago. This is what we've done in the last 1 week in sense of many of these metal prices. So 2% down for copper in last 6 or 7 trading sessions. We've seen steel, zinc decline by 3% and 2.5% decline for aluminum. Iron ore continues to be your underperformer, 6.5% down in last 1 week itself. Within this space as well, I'm looking at copper because this is an area everybody says is going to be on the stronger side. The long-term fundamentals are strong. Remember, for a mine or a new project to come online, it takes 8 to 10 years. So the previous projects will come online this year and the next. But after that, post-2026, most markets believe that you are looking at lower supplies in sense of copper. Codelco, for one, which is the biggest copper producer, has revised output projection for the first half of this year, we've seen Codelco output decline by 14%. And for this year now, they're anticipating output at 1.3 to 1.35 million tons or thereabout. The other important one to watch out for is that the US Department of Energy in this week has added copper to critical material list. I mean, they perhaps have been the last ones to do that, because when you look at the list of countries who've already done that, that includes India, Canada, Japan, and various major other consumers as well. European Union, China, etc. already have put copper on a critical list there. Other thing to know is that copper is used for clean energy generation, transmission, storage, photovoltaic cables, infrastructure, and EVs, etc. So copper demand going forward in the next decade is expected to double from where we are right now, and not so much copper is going to be available. But looking at the kind of economic data China is throwing up for the near term, that is what seems to be putting some pressure.
Okay, Manisha, thanks a lot for that. Let's slip into a quick break. On the other side of the break, Bhanu Chopra of Rategain Travel Technologies will be joining in to talk about the quarter gone by. Stay tuned.
Welcome back. Don't be fooled. The Nifty has not moved a single point, actually. It's more or less as flat as can be. But from the broader markets, plenty of stocks are moving around. Rategain is one such stock, and that's the next corporate on our radar. Revenues are up by close to around 80% the first quarter. They aim to double their revenues in the next 3 years. To understand more about the way ahead, we're joined by Bhanu Chopra, the Chairman and Managing Director at the company. Hi, Bhanu. Good morning. Thanks so much for joining in, and congratulations on a solid showing in the first quarter. Now, what's the way ahead? Do you maintain that organic growth of around 25% or thereabouts, and also 55%, I think, for FY24? Do you believe on the revenue side, actually, you can outbeat this 55%? Also, margins, I think you were guiding for around 200 basis points improvement. So FY24, 17 to 18% doable?
Yeah, so first off, Nigel, thanks for having me on the show. So yes, at the beginning of the fiscal year, we'd guided for about 55 to 58% growth and about 17% in margin. But if you look at our Q1 numbers, they've actually exceeded those targets. We came in at about 80%, and our first quarter margin, you know, we'd guided for about 13.5%, but we are at 17.6%. So if you take cues from Q1 and how we performed against the fiscal year target, so I'm pretty confident that we will beat the guidance that we gave. What the delta would be, I don't know. I can tell you in terms of overall industry trends, you know, there is a lot of tailwind that's behind us, given, you know, the attitudes of people have changed. If I ask you what is, you know, the next big thing on your list, I'm sure you're going to talk about travel. And that's how most people are reacting. So even though there's talk about, you know, inflation rates and also interest rates going up, we don't see any letdown in people wanting to travel. So if you look at our customers as well, they're doing extremely well. They're reporting record revenues and bottom lines, and they want to digitize. So I believe the best is yet to come.
Nigel, it'll be travel on a bike. So, you know, I can combine two things there. Well, Bhanu, good morning. Congratulations. Super set of numbers. Prashant here. You said you're confident you will beat the guidance of 55%, right? Which you put out earlier. If you want to put out numbers, please do. What kind, by how much? Some broad way to think about it. How much of it will be organic? And on margins as well, is there further upside? 17.6% this quarter. What can we look at by the end of the year?
Yeah, so look, you know, as I said, we're seeing some, you know, dramatic moves by our customers in terms of, you know, their digitization needs. So it's a positive surprise for us. I mean, one of the things I will point to you is, you know, the fact that AI has become sort of pretty big on everyone's radar. And one of our business units is data as a service. And for any AI model, data is the key ingredient. So what we are seeing is all our targets are being surpassed because the amount of data volumes that these AI models need, you know, for decision support systems, you know, is going through the roof. So that's what we are witnessing. I can't put a number on, you know, what it will be. Like I said, I think I'll be able to come back and give you better guidance in the next quarter. But I can tell you, we're having another very, very strong quarter, the current one. And I'm very, very confident about beating both the revenue as well as the margin numbers of 55, 58% on growth and 17 to 18% on margins. On a steady state, something that I mentioned on the earnings call yesterday as well, you know, this business can easily be about 25 to 30%, but, you know, we've implanted a lot of seeds, and each of these seeds have huge opportunity to grow. So we want to continue to reinvest, but on a steady state, we can be a 25 to 30% margin business.
And you are in the right place at the right time, right? I mean, your travel and hotel software, I mean, how can it get any better? Especially at a time like this, I agree when you say that travel is the only thing on people's minds. And now, whether it's Agoda, Bookings.com, Expedia, and these are the guys that you service as well. I mean, their bookings are going through the roof. So tell us, any M&A plans that you have? You have some cash on your books as well, I think to the tune of around 600 crores or so. Any M&A plans?
Yeah, Sonia, so the cash on books currently is about 350. We've come out with a proposal to do a QIP for another 600. So on the M&A side, as you know, we are very, very active. We did the Adara acquisition, and that's gone extremely well for us. So we are an acquisitive company. We're looking at targets in these areas where we operate around DAS distribution and MarTech. We have a very robust pipeline, but we are also fiscally very, very disciplined on what we are willing to pay. But I'm pretty confident. If you look at our track record, we've been acquiring one company a year since 2018, except for the COVID year. So, hopefully there'll be some news for me to share next time I come on the show.
We hear about this news, and out of, you have 300 crores, you're looking to raise 600 crores. So what could the acquisition size be? We're running a little short on time, but if you squeeze in a couple of numbers.
See, the sweet spot that we've had so far is around, 150 to 200 crores, but there are a couple of opportunities that we are looking at, which are beyond that. And I do feel that, there is enough opportunity in the marketplace, given the pipeline that we have, that we need to create a war chest, and that's what we want to do. So as you can see, our numbers are, in terms of profits and free cash flow generation, is very good. So it's really, using the money for M&A.
Okay, all right. We will come back to you when you have more clarity on, what the money will be used for in terms of a timeline, etc. But thanks a lot for joining us on CNBC TV18. Let's slip into a quick break. On the other side, Lata will get chatting with Devdatta Chand of Bank of Baroda to talk about the quarter gone by. Stay tuned. Welcome back.
We are continuing with earnings analysis. Bank of Baroda reported a strong set of numbers, 18% advances growth, 16% deposits growth. The asset quality excellent, annualized slippage ratio lowest in 11 quarters. Cost to income ratio is actually lowest in 22 quarters. Yes, the pressure on margins is what everyone noticed. But for more on the bank's results and its outlook, we have the person who has just taken over as the managing director, Mr. Debadatta Chand. Mr. Chand, thank you very much for joining us.
Welcome.
The first question really is this loan growth. It's Bank of Baroda's loan growth, 18% was very good. And we are getting the same thing even from other NBFC companies, 18 and 20% growth. Does it look like it can continue like this?
Yeah, Lata, I believe that we can continue the loan growth journey. The reason being, this is particularly a very unique quarter, wherein the bank could optimize on the loan growth side, at the same time maintaining the margin almost at 3.3, at the same time giving a 88% growth in the net profit. So if I look at a couple of what you can say the main important aspect of the banking in terms of the top line, the bottom line, the asset quality and the margin. For Bank of Baroda, all four factors have come very good for this quarter. And that is what important part of the entire that we are communicating to the market, that the bank is trying to optimize on every front. And my sense that going forward also, since the demand is there in the economy, the growth would be possible to replicate for the consecutive quarters. But for a guidance, we have slightly given full year guidance slightly lower than the 18%. The reason being, at some point of time, the base effect also would start kicking. So the overall guidance to grow around 15% for the full year. But going forward for quarter to quarter, the growth can still be around 18%, which we have achieved in the first quarter.
Okay. No, that point is taken. You said margins are maintained. From year ago levels, you'll have maintained. But your fourth quarter margins were 3.53. So are you confident that you can even freeze it at 3.3? Because deposits will catch up. Liabilities always catch up. So there is a fear that it can come down to 3.2, you think?
It's a fact that the cost, there is a push in terms of the cost of deposit, and that has, if you look at the growth, the percentage increase in the cost of deposit higher than the last quarter. At the same time, we also say that there is a significant percentage of the MCLR books still to get repriced. Because all this 1 year MCLR get repriced at the end of 1 year. And since the repo rate hike was intervening below 1 year, so there is a bit of a portfolio which is there, which can still be repriced for the MCLR. The second aspect, we are pushing very clearly now that we also wanted to have a lower cost to income ratio. Although we are not giving any numerical target for cost to income ratio, but then clearly the bank started working on that. If you compare the YOY reduction in cost to income ratio, it is almost like 945 basis. If you exclude the MTM impact, then it is almost 166 basis. So a couple of things which again we are trying to figure out is to how to again create a efficiency in terms of the cost to income ratio. So I believe that we are guiding the market that we will be in a position to maintain 3.3% going by the outlook we have as on today. So with any change outlook, things can be different, but currently we hold our guidance of 3.3% on the NIM side.
No, this is very important what you say about OPEX, because even your previous MD was telling us that they were able to bring down branches where it was coinciding with the banks that you all took over. And obviously, because Bob World is working, those are cost efficiencies. You think you can still optimize in terms of replacing retired workers or retired employees, or even branch rationalization? Even those spaces are available for you?
It's a holistic in terms of how do I look into the cost to income. There are two ways I need to look into. One is a case where I optimize my income side more. The other is to reduce the cost. So the cost matrix goes in terms of HR also, in terms of branch also, in terms of process automation also. The point that I have also said earlier is that as a bank, we invested heavily into the product side and also on the HR side. But now time has come to look into the process side also. So I believe all this would result into some kind of a better optimization on the cost to income, and that would help the bank to maintain its margin going forward.
Okay. What stood out about your post results, message to analysts is that you expect to grow overall 2% faster than the system, and retail you said you were expecting to grow, I think, 5 percentage points faster than the system. You're confident of that, and I'm asking you because there are 2 or 3 challenges. HDFC is with HDFC Bank, and that is cheap money and a system that knows how to give home loans. And then there is Jio Financial for consumer lending. So you still think retail is achievable?
It is actually. It's not like it's a one quarter we are given a 25%. If you look at last 8 quarters, the retail growth has been better than the market. And it talks about my delivery in terms of retail that is much more important. A couple of new things that we started rather a couple of quarters back, and now we are trying to optimize is the sales part of the entire retail. So we are strengthening the not only the credit delivery in terms of retail, at the same time we are also trying to have more sales executive to drive retail. One.
Okay.
Secondly, another structural change we have made in terms of our processing center. We had limited processing center in terms of retail with the same control.
Okay.
With the same control, we are trying to have more processing center, and that typically can reduce the lead time in terms of sanction. That is what we call it TAG. So with that, I believe the franchisee is working very well and continue to do same way, and will maintain that kind of a what we can say delta over market, and that is what will pursue.
You're hoping to achieve. Okay, I'll tell you 2 or 3 fears that you hear from RBI and other banking sector watchers, that unsecured credit is a worry for the RBI. They've written to some banks and NBFCs. The second thing is, some people worry that retail is overcrowded now. You know, big banks are, some of them 65% into retail, and at some point the cycle turns. You know, some of them have already got very good retail history.
Yeah.
Some of you are new to retail.
Yeah.
So there is a fear that in the first cycle, will you have a problem in terms of asset quality?
No, let me tell a couple of data points before I come to the subject, that retail debt as a percentage of GDP is very low in India.
That is true.
So there is a huge upside.
Unmet demand.
Yeah, that's available. The second aspect is that the market significantly now moving from asset-based financing to cash flow-based financing, because people do have adequate cash, and for that they can service a loan in much quicker time as compared to earlier. And as far as we are concerned, I have a aging of almost 3.5, 4 years on the retail side now.
Okay.
Secondly, my portfolio is almost now 20,000 crore, which is also a sizable in terms of looking into the portfolio side of it. But as far as Bank of Baroda portfolio is concerned, these are all existing customer availing, almost all existing customers.
So you have data on that.
So we have the data on that. We have their cash flow, the life cycle, everything with us. And as on today, the percentage of NPA is very low as compared to any other retail loan.
That is true.
And when I compare, if I typically look at the growth, it looks high, but then my base is very, very low. If I compare the largest bank had a much higher portfolio as compared to the portfolio I do carry. So a scenario at which there is a change happening in the market, point one. Secondly, the retail debt as a percentage is quite low for India. Then I think there is a potential available therein. The only aspect that which the system talking about it with regard to that, whether I do have the adequate risk matrix to do the appraisal. And Bank of Baroda, we do have those kind of risk matrix to appraise and underwrite properly.
Oh, fair enough. That's good to hear. What's your sense about, the kind of recoveries you can get from NCLT? You have a decent number of amount of money in assets in NCLT, and plus now Go Air looks like it is recovering, but still there is a little bit of a red flag. So any statements you can give on asset quality? Annualized slippages now are among the best. But going forward, you think even the big loans?
Yeah, couple of guidance we have given to the market. One is that to maintain the GNPA around 3.5 and the net NPA around 0.75, and the slippage would be around 1 to 1.25, and the credit cost would be below 1. So although NCLT is a kitty, because it all depends upon all processes they are in, so without getting into that account wise, but I believe all these numbers are achievable based on the current, what you can say, on the recovery that we are seeing and the slippages that we are seeing. We have also said that my recovery for the full year would be 12,000 crore.
Okay.
And we also said that the net slippage would be negligible, or the delta can be something around 2,000 to 3,000 positive. So in that scenario, I am quite helpful to maintain all this guidance that we have given to the market.
Fair enough, fair enough. Your other, guidance to the market, or whatever, it's a positive that the market sees in you, is the recruitment philosophy in Bank of Baroda has changed from the time you had a lateral recruit as a managing director from the private sector. I think the only example I know of a public sector bank having a private sector head. Later on, you all had the chief digital officer, CFO, all of them from outside. You intend to continue that practice, and are you confident it's working well?
Yeah, it's working well, and I do believe the stance would continue. The philosophy behind this, or the bank stance, is that areas where, particularly a bank like us, a PSU, the market has moved ahead of us in terms of those kind of, implementation. We need to have somebody from outside to allow us to catch up. So areas where we as a, the PSU bank, we are not at par, we'll continue to have those wherein we'll have market expert who can again drive us to achieve those numbers. So the experiment Bank of Baroda, this process started something around 5 years back, and it's perfectly working. And as a stance and strategy also, I very clearly said earlier also, anything in the bank which is giving us positive dividend, as far as I am concerned, will continue on all those aspects which is giving positive dividend.
Okay, that's good to hear. Just a word on when we were talking asset quality, you had more provisions than people expected. You put some floating provisions. You will continue to do that?
See, that's why we believe that my only objective is to not to optimize on the profit side, but to also strengthen balance sheet. Right. The PCR is all-time high at 93 point something. So this would continue as a hygiene and strategy to strengthen balance sheet. So wherever there is a possibility for me to create some kind of a, bit of provision which can also give me a bit of comfort going forward for any headwinds that the market can see, then I think that's a proper strategy and proper, for the bank also comforting all analysts and all market participants for the matter.
Okay. Well, a final question on your capital. Will you want to divest in any of your investments in say NSE or anything that you may have, anything that you will do to your book, or will you even raise capital, because the market is very kind to banks now?
So rather my first point is that the PSU bank, we are in a very sweet spot at this point of time. And the performance for last, if you look at 8 quarters, these are very consistent. Rather, I would expect a re-rating of banks PSU as a pack rather looking at one particular bank like me at this point of time, point 1. Point 2, as far as Bank of Baroda is concerned, my CRAR is now 15.85. And
no, you don't need. I was only saying the market is kind, so why not take advantage?
No, we do have mandate to raise 81 and tier 2 for 5,000, but since the CRAR is quite comfortable, we are not looking at any capital raise at this point of time. The second aspect with regard to a divestment, we as a bank pursue that actively at any point of time. But the final decision would be based on the conduciveness of the market and the valuation. So all wherever my own subsidiary or wherever we have strategic investment, we always pursue for getting some of them monetized, but then all would depend upon the valuation and the market conduciveness.
Okay. No, I can understand waiting for better valuations for PSUs as a whole seems like a great strategy. Mr. Chand, thank you very much for spending time with us.
Welcome, Lata, and pleasure interacting with you. Thank you.
Okay. Welcome, sir. That's it from the BOB management. We're going to a break. It's time for Chartbuster.